Imagine waking up every 3 months to find money deposited directly into your bank account. No extra hours at work, no exhausting side hustles, and no need to constantly stress over the stock market. Sounds like a dream, right? Well, for thousands of Canadian investors, this is exactly how dividend investing works. But here is where most beginners make a costly mistake. They chase the highest dividend yield they can find. They think bigger is always better. Unfortunately, that's exactly how you fall into dividend traps. Companies that look incredibly attractive today but struggle to pay you anything tomorrow. If your ultimate goal is to live off passive income, you don't need the highest paying stocks. You need the safest businesses. You need reliable cash flow, bulletproof balance sheets, and management teams that have proven they can reward shareholders year after year, through thick and thin. In today's video, I'm revealing 3 rock-solid Canadian dividend stocks that long-term income investors continue to hold through market crashes, recessions, and economic uncertainty. These aren't flashy AI startups or speculative penny stocks. They are essential businesses that quietly generate billions of dollars every year, sending a massive chunk of those profits right back to you. Make sure you stay until the end, because our final stock has one of the most impressive dividend track records in Canadian history. And it's a company many investors underestimate simply because it's boring. Quick disclaimer before we jump in. No stock is completely risk-free. Share prices fluctuate, and dividends are never 100% guaranteed. Always do your own research. Now, let's start with a giant that almost every Canadian interacts with daily. When people think of stability in Canada, the Royal Bank of Canada is usually the first name that comes to mind. From personal banking and mortgages to wealth management and insurance, millions of Canadians rely on RBC every single day. And that is exactly what makes this company a powerhouse. Instead of relying on just one product or a single industry, RBC's revenue is incredibly diversified. If one sector of the economy slows down, another area helps balance the books. This exact diversification has allowed RBC to remain one of Canada's strongest financial institutions for decades. What many new investors don't realize is that Canada's banking system is globally renowned for being among the most stable and strictly regulated in the world. This is why Canadian banks are a favorite for income investors worldwide. Now, let's talk about the dividend. RBC doesn't offer an unsustainably high yield just to attract eyeballs. Instead, they focus on steady, predictable growth. They have a legendary reputation for regular payouts and a history of increasing those payouts whenever business conditions allow. Imagine investing $100,000 into a portfolio of dependable companies like RBC. You won't get rich overnight, but every dividend payment can be automatically reinvested to buy more shares. Those new shares generate even more dividends. That is the magic of compounding. Over time, a modest income stream transforms into a financial snowball. Of course, no investment is perfect. If Canada faces a severe recession, loan defaults could rise, impacting bank profits. But because RBC maintains massive capital reserves and operates across multiple financial sectors, history shows it is uniquely positioned to weather economic storms far better than smaller institutions. Our second stock is completely unexciting, and that is exactly why dividend investors love it. Think about your daily routine. You wake up, turn on the lights, charge your phone, and make coffee. You don't spend a single second thinking about where that electricity or gas comes from. That's where Fortis comes in. Fortis owns and operates regulated electric and natural gas utilities serving millions of customers across Canada, the US, and the Caribbean. Here's the beautiful thing about this business. People need electricity whether the economy is booming or crashing. Businesses still need power, hospitals must stay open, and schools must operate. Demand doesn't vanish just because the stock market had a bad month. This creates the holy grail for income investors. Highly predictable cash flow. Because Fortis relies on essential infrastructure rather than unpredictable consumer trends, its revenue is remarkably stable. In fact, Fortis is a dividend king in Canada, having increased its dividend payout for over 50 consecutive years. When the market gets volatile, experienced investors run to defensive companies like Fortis, while it isn't immune to market declines. Since rising interest rates and heavy infrastructure spending can affect short-term performance, its underlying business model remains rock solid. If your goal is financial freedom, remember this: boring is beautiful, and boring can be incredibly profitable. Our third stock combines a higher dividend yield with an essential business that serves as the backbone of North American energy. It's a cornerstone of almost every Canadian dividend portfolio: Enbridge. Now, there is a major misconception that Enbridge's success depends entirely on oil prices. That is completely false. Enbridge isn't a drilling company. They don't dig for oil. Instead, they own and operate one of the largest energy infrastructure networks in the world. Think of them as a toll road. They own the pipelines that transport crude oil and natural gas across thousands of kilometers. Whether oil prices are high or low, companies still need to move their product through Enbridge's pipes, and they pay a toll to do so. On top of that, Enbridge operates a massive natural gas utility and is heavily investing in renewable energy projects to future-proof its business. BICA. Successful dividend investing requires a shift in mindset. Imagine two investors. Investor A checks stock prices every hour, reacts to every scary news headline, and constantly flips stocks hoping to beat the market. Investor B buys financially strong companies, sets up an automatic dividend reinvestment plan, adds a little bit of money every single month, and goes on with their life. History proves that Investor B almost always comes out ahead. Not because they were smarter, but because they gave compounding the time to do the heavy lifting. Let's look at a quick mathematical example. If you build a diversified portfolio yielding a conservative 4% annually, a $250,000 investment will generate roughly $10,000 a year in pure passive income. If you reinvest those payouts and keep adding your savings, that number will compound exponentially. This is why experienced investors don't just look at today's dividend yield. They look at tomorrow's dividend growth. A company that consistently increases its payout year after year is infinitely more valuable than a high-yield stock that ends up cutting its dividend next quarter. Even when dealing with giants like RBC, Fortis, and Enbridge, you should never put all your eggs in one basket. Diversification is key because different sectors respond differently to the economy. Think of your dividend portfolio like a sports team. You don't want one superstar doing all the work. You want a balanced lineup. RBC gives you the strength of the financial sector. Fortis provides the bulletproof stability of utilities, and Enbridge delivers high-yielding energy infrastructure income. Together, they form a balanced, resilient shield for your wealth. Instead of asking yourself, which stock will double next month? Start asking a better question. Which companies are going to keep paying me for the next 10, 20, or 30 years? That single shift in perspective will change your financial life forever. The journey to living off passive income starts with a single investment, followed by another and another. Stay consistent, keep learning, and let time become your greatest financial advantage. If you found this video valuable, please smash that like button, subscribe to the channel, and turn on the notification bell so you never miss our latest deep dives into investing and smart money strategies in Canada. Thank you so much for watching. I'm James, and I'll see you in the next video right here on Canadian Finance Hub.